So the big news of the day is over the last couple interviews we've had, I've talked about how I do expect a market corrective move. The key was a break of a major trend line. And here, if we look at my charts, you can see that this trend line I've been watching goes all the way back to the lows from March of 2020. So that's why you know it's a major one, because this move from the pandemic panic lows has never been broken until today. And this is what I'm really watching and what I think could trigger as much as a 10% correction. And again, notice today's action on the S&P here, we're trading below this line. So assuming we don't get some sort of crazy rally into the end of the day and we close below this line, look for continued weakness over the next couple of weeks. And again, it could cascade into a fast sell-off that could take us maybe as low as 3,800 on the S&P.
Okay, this 10% correction that you're referencing right now, you've talked about this several times in the show. What is a potential timeline for this correction?
Well, once the break occurs, which again potentially looks like today, I think it can happen as within a month's period. So I mean, it will be rapid. I hesitate to say 2 weeks because that's cutting myself very slim there. But I do think it's a fast one. And again, it's a technical thing. So if you think about a level breaking, like on the Bitcoin chart where I called the 30,000 collapse from 50,000, that happened within 3 days. Now I don't expect a significant 3-day 10% correction in the S&P because it's not as kind of concentrated in terms of positions, but you're definitely looking at a fast move to the downside as the algos are triggered here, the computer programs, the institutions. I'm not the only one that sees this trend line out there, and it will trigger other bigger players to sell.
Okay, so you're not, all right, I had this image in my mind of a flash crash down to 10% where the circuit breakers are triggered. That's not what you're referring to, right?
No. In general, I don't think a flash crash type event. I mean, it's always possible with the volume as low as it's been lately. It does make the market very vulnerable to a flash crash. But I would generally say you're talking about a few weeks to 2 to 4 week type period where we could find ourselves, by this time next month, down 10% at least on the S&P.
Okay, thanks for clarifying that. I feel so much better now. Awesome. All right, I want to talk about the Federal Reserve because that was the big news for people following monetary policy this week. As you know, their stance is interpreted as much more hawkish than before. What was your major takeaway from watching Jerome Powell's speech and, of course, the release of the dot plots?
The two hikes. So let me say a couple things. First of all, not for the first time about the dot plot. These are, of course, individual projections. They're not a committee forecast. They're not a plan. And we did not actually have a discussion of whether liftoff is appropriate at any particular year, because discussing liftoff now would be highly premature. It wouldn't make any sense. The dots are not a great forecaster of future rate moves, and that's not because it's just because it's so highly uncertain. There is no great forecaster of future dots.
Yeah, so they're definitely starting to inch towards that tightening phase. As Powell said, they're talking about now officially, as the market's been wondering when that was going to happen. So I think that's key. I think the market kind of initially thought to themselves, and we saw this rally yesterday, the day afterwards, saying, okay, well, they're still talking years out. And then we had another Fed official come on today. I think it was Richard Fisher, and he basically talked about that inflation is definitely hotter than they thought. And it was the first time where the Fed kind of realized, or at least announced to the public, that they were possibly behind the curve on the inflation side. And I think that was significant, right? So if you listen to Jerome Powell the other day, he didn't really say, it's the inflation's hotter. But today we did hear that. And I think that's why the markets are freaking out just a little bit.
Just a little bit, but not a lot. We're going to be talking about the precious metals market in just a bit, but I'm looking at the stock market again now. Gareth, can you pull up an S&P 500 chart one more time? We did not see, okay, that was a move, but if I were to, if someone were to tell me, the Fed's raising rates, I would expect a bigger move downward, personally.
Mm-hmm. You're right. So just keep in mind that there's still a lot of average investor money coming into the market on a daily basis. There's this kind of thought process that every dip is a buying opportunity. So until proven otherwise, you're going to coax money into the market on these days where the market's trying to sell off, but then new money's pushing it back up. So remember, corrections, when you look at when crashes happen, generally the big moves come at the end of a down move, not at the beginning. And the reason they don't come at the beginning is because at the beginning, everyone is still very optimistic. People are still greedy. You're still seeing the meme stocks pretty hot. So there's a lot of money that wants to be in the market, and it's not scared yet. Once you get scared money later on, that's where the acceleration to the downside should come.
And you mentioned to me offline as well that trading algorithms around the world could be analyzing this chart and trading and taking action on that break in the trend line. What could they be doing, Gareth?
Yeah, so absolutely, these algos. I mean, again, institutions have great minds, even better than me, and they're very aware of this break, and they're probably in their boardrooms right now deciding, do we start to unload quicker? One of the things I pointed out to a lot of people over the last 2 to 4 weeks is that we've had multiple days where the markets open higher, and then you'll see the first hour of selling pressure. I'm trying to look on my charts to see if I can show this here. Let me see here. So you can see on the spiders, like right here, it opened higher and sold off. Over here, opens a little bit higher, sold off. Opened here, sold off. Opened over here and sold off. And to the average investor, that may not seem significant. And again, this is the 10-minute chart, so this is looking on an intraday micro basis. But what that's telling me is when you see selling from the opening print early in the day, that's institutions selling when there's volume present in the market. So an institution can unload a multi-million-dollar position over lunchtime when there's no volume in the market. They have to pick their spots so that they don't crash the market. And what we're seeing again for literally the last month is this continually happen where the markets open up, then the selling comes in, and then around lunchtime or late morning, it subsides and the markets float back up, much like yesterday. Yesterday was a great example. We floated right back up into the end of the day. That's a signal I've been noting that also tells me that there's distribution going on in the market and investors should be aware.
I'm also noticing just on that chart right there that you pulled up a lot more trading volume. Let's talk about that. What is that? Is that mostly from the short side? I would imagine.
Yeah, so I mean, every short has to have a long, so keep in mind, but basically the volume kicked up as soon as the Fed, I mean, you can see right here, this is where the Fed announcement came out on Wednesday, and look at the spike on volume and then continued yesterday, and then obviously with the drop today, a lot more participants. So it's basically telling you that there was some sort of shock to the market that triggered people to either want to buy or sell. In this case, with the markets trading lower from that point, it was a